Good morning, ladies and gentlemen. Well, Trump has finally bombed Iran, so it'll make for an interesting opening. But let's discuss what is more important longer term, and that is what the Fed did and the projections. As you can see, it's a whiff of stagflation. They've lowered the GDP growth by zero point 0.3 and zero point 0.2 for 2025 and 2026, increased slightly the unemployment rate, which I think is the likely path towards 4.5, which is still not a disaster by any stretch of the imagination. And they have upped the PCE inflation and core inflation by zero point 0.3 for this year and then zero point 0.2 for next year. And even 2027 is zero point 0.1 higher before the longer run remains at 2%. They have left the dot plots exactly the same for 2025, upped by 2 for 2026 and up by 3 actually for 2027, indicating that the terminal rate for this cycle is going to probably be higher than they assumed before. And if we have a look at the actual dot plots for 2025, we can see how divided they are. Half of them basically say no cut, and half of them say just over half, one more than half say 2 cuts or more. So they are very divided, and the proviso that Powell gave us that they had to write something down is very valid. I mean, they just don't know what the tariff level is going to be after the 9th of July, and they have therefore no idea of the extent of the pass-through to inflation. It could be lower, it could be higher. Any of these dot plots is possible. And therefore, poor people, I don't know what I would have put down in any case. What is clear is that they all think that inflation is going to be temporary and that sometime in 2026 or in 2027 we have rates somewhere around 3.25% or lower, and that the longer run is still the same. It's still around, but look how divided they are here. Some people think that the neutral rate is well higher, and some people think it's still unchanged. So we have a whiff of stagflation, and that's about it. It's going to take longer to get to target, but it all depends on what the tariffs are. A complete mess still. And why the Fed is so reluctant and so divided and so uncertain is because of this chart. It gives you the level of tariffs. They are going up and down like a yo-yo, since February. It's just so difficult for the Fed to determine what the extent of the pass-through is going to be. Because don't forget, tariffs are on goods, so they're not on services. And the goods are a much smaller component of the economy than the services. And it all depends on the secondary effects. Do wages then go up, etc., etc.? And this all takes a long time to feed through the economy. First of all, we need to get stability in these tariffs, i.e. we need to get to a level that we know we're going to maintain and not keep on going up and down like Trump is causing. After that, we need to wait to see what the pass-through is in terms of how much is absorbed by what side in the exchange. So importers versus consumers, etc., etc. And finally, we need to see what the effect on the wages is going to be. So this is why I really don't think that can be ascertained by the Fed any time before September. And that's why I don't think that the meeting in July is going to be live, whatever Waller might say. More important is how the bond market reacted, and really the reaction was exactly as I anticipated. Very, very little movement at the short end, but better, i.e., we feared worse. We are still on track to have the 2 year trades between 270 and 4%. Very, very tight range. And really, we can't get the yield curve to steepen properly at the moment. We are not going to get cuts until September. I know that Wallace said that July is a live meeting, but it's unlikely to be so, simply because I don't think that we're going to have all the clarity that we need by the July meeting in terms of tariffs. It could very easily be that July the 9th target gets postponed, moved. It needs more time, especially now that he's concentrating on the war with Iran. It might be one strike and we're done, but it might easily not be. And therefore, it's terribly unlikely that we get a resolution of the tariffs by July, and therefore they won't know how to move at the meeting. So until you get a real proximity to cuts, and that won't happen for quite some time, I think it's going to be September, you will get the 2 year note just meandering in this corridor. And therefore, you just can't get proper steepening. Let's have a look at something like 2's fives. You can see 2's fives have really not moved since the Fed at all. They are exactly the same as they were, and they could easily keep on going sideways for a bit. People are doing steepeners, but they're doing something with duration, i.e. 5's 10s, 5's 30s, and let's have a look here. 5's 10s. Okay, you can see how it just will not rally. That means the curve wants to steepen, but in 2's 10s it just can't, right? And 2's 30s, it's finding it very difficult. 2's fives, it's finding it very, very difficult. Just finding it very, very difficult with 2's, because A, you have the negative carry, and B, it's just not, the timing is just not right. If it's September, we still have 3 months to go. So what are you going to hold this position for 3 months and see no benefit? I doubt it. So all the steepening is in 5's 30s or 10's 30s. Those are the only things that you can hold as a steepener. Here's your 10's 30s, and it keeps on going and it keeps on going. I think any kind of small move back is the sell. The curve wants to steepen, it just that it can't do it now from the very short tenures, as simple as that. What is also evident is, and I know that on Monday it's probably going to jump because of the Iranian attack, I think that this will continue from spikes to move lower. I think the yield curve is stabilizing. We all know it wants to steepen, but it's going to have a very tough time. And I think we are going down in terms of the volatility, and we're going down towards levels that will be in the 70s at some stage. That's the trend. Everything I've said for the US applies to Germany as well, and the EU in general. It's very difficult to see the 2 year Schatz move anywhere now. As I said last week, it's a dead contract. Same really for the 5s, with a little bit more volatility, and the 10s. And here you also find it very, very difficult for the curve to steepen. They're just, the negative carry at the short end makes it prohibitively expensive. The ECB has told you they're now going to watch for a long time. So Germany probably has less possibility to flatten at the to steepen at the very, very short end than the US does, because I'm quite convinced that the next cut is probably coming from the US rather than the ECB. So you have the twos fives just going sideways. You have the twos tens, if anything, going up a little bit because of the carry. You have the twos thirties going absolutely nowhere. We're at the same level that we were in April with a very, very tight range. So where is the steepening, if any, going to come from? Well, it could come from something like 530s, but it's got to come from levels, and we are nowhere near those levels. It's almost impossible to have any kind of position that you want to hold in the as a steepener in these contracts until it spikes to a level, and we're nowhere near. We are just meandering. So patience here is going to be key. You just cannot position for a steepener, which is the natural position to have in the European contracts just now. What you can do is you can buy something like the like this contract, tens, Italy against Germany, on spikes, because if the Europeans are going to do nothing for an extended period of time, you might as well pick up the 100 basis points that the Italian contract offers, or something like a little bit of France, and do it that way. If you think about what the big money is doing at the moment, the big money is parking itself in the area of 3 years, 4 years, 5 years, 7 years, staying short, not going for big duration, i.e. 20s and 30s. They're keeping it between 3 years and 10 years. That's where they want to be positioned. That gives them the maximum flexibility for what the central banks are going to do over the remainder of this year. Tens and 30s, anything over tens and up to 30s is very, very dangerous. You could get spikes now in oil. Who knows, they might close the Straits of Hormuz or things like that. And those events are going to be much more reflected in the 10s to 30-year area than they are going to be at the very short end. Even if they closed the Strait of Hormuz and oil went up to, I don't know, make up a number, 120, you are not going to get a big move in the 2-year note. You're going to get that move in the 10s and 30s, and that is why people are just going to sit tight in the 3 to 7 year area and do very little else for the remainder of the summer. So the natural corollary to everything I've said is that I think twos and twos fives, US versus Germany, is on the way to come in. And I know that the 200-day moving average is rising, but I think that at some stage over the course of the next 2 or 3 weeks, we do trade 192 in the twos, and the fives are now below the 200-day moving average, and we could easily see that at 175. I think that those rates in the US are more likely to come down than they are in Europe, because Europe now, I think, is going to be dead. So any flight to safety or anything like that is going to be reflected in the US rather than in Europe. Those differentials, I think, come in slightly over the course of the summer. Why not pick up the extra yield? That's what seems to be happening. Every time it goes up, it can't sustain, it comes back down. I think the natural level is going to be somewhere down here. It's going to be interesting to see just how weak the dollar is on Monday after these Iranian strikes, because if all the dollar can do is rally to something like 99.80, it just shows that it's weak. If after 2 or 3 days we're no higher than 99.80, then I think the path of least resistance again is south. 99.79 here on the weeklies. If all we can do is touch it and come back and not really do much better than that, then we are probably going to touch all the way down to 96 over the course of the summer, as we anticipate that the Fed is going to cut rates sometime in September. So I'm not positive on the dollar at all. I think the administration wants it lower, and I fully recognize that you could get spikes over the course of the next week or two depending on the situation in the Middle East. That's why all I have are some longer term options, and I am fully prepared to sit with them and only act once we get to important levels. Again, if it's no higher than 99.80 over the course of the next week or so, it's showing weakness. And even 139, it's still showing weakness. All it's doing is, going sideways, and after the sideways period, the trend will reestablish itself, and I am convinced that at some stage we trade this very important 96.47 area. Translated in Euro USD, you are talking about this kind of level 113.05. If we can't get below there over the course of the next week or so, then we are just weak in terms of the dollar and strong in terms of Euro USD, and we still have one leg further to go to these levels, the 118s and a half. So to me, it's clear that the administration wants a weaker dollar, and I will only be looking at levels to buy Euro USD as opposed to sell it. This spike that we possibly get on Monday from the Middle East, it's going to be, I think, a bit of a godsend here at 113.05, and 113.05, it's definitely worth punting to the upside. It's going to be interesting to see where GSG trades on Monday. It's, very overbought, and normally when the fighting starts, that is your signal for a top for a bit. So if it's up here 24.40, I'm definitely going to start taking profit on my longs, looking for a move back down towards 22.90, 22.50. And I really want to buy it again and remain long of it, because if you have a look at GLD GSG, it's doing exactly what I thought it would do, some kind of ABC, come down to here, and then probably that's it for the time being in gold GSG. Gold itself, it's likely probably to spike a little, but it seems to have lost all its impetus. It just can't close above 34.30. And if you can't close above 34.30, you see, you've got these highs. High closes, always look at the closes. If that's all it does, it's probably likely to stop some people out that have accumulated here and come back towards this, 32.40 area. If that's all it does, then it's telling you that the situation is, not too bad. But if it starts breaking above 34.30, I guess you have to chase it. That's all I can say about gold. I still prefer GSG to gold for the time being, but I can see that trend, and I show that chart again, is coming to an end. Around here, that will be it, but I expect it to be corrected via a move back in GSG rather than a move up in gold. Bitcoin is actually behaving like a risk asset. All last week, it just could not break above 106,235 and close there. And then we had, we are getting the risk off that equities will probably get on Monday. It's, it's not weak, but I think that at some stage we do break this 1001 650 and we get a spike below 100,000, and I would really buy it somewhere between 96,000 and 92,000 for a bounce. It's probably going to take a while, but I just don't see that this is impulsive, and I just don't see that this is anything but a risk asset at the moment, which is more likely to trade down towards this 92,000 level than start going higher. People are long, people are probably wrong, and you need to get some nice stops going before this can make the next move up. I am just not positive for the time being. I am flat. I would much rather, at these levels with volatility where it is, be long calls than long the outright. It's more likely than not to trade down. This is a chart of MSTR over STRF, so the ordinary shares over the ones giving you 10% yield. It's a very short chart, I know, because this thing has been around only for a couple of months, but you can see, especially if you overlay this over a chart of BTC, that while it's going up, it's a sign of BTC being in risk on, and why it's going down, it's a sign of BTC being in risk off. I think that you need to look at this chart to get an idea of what the possible upside ranges are in BTC. I think this continues down for the time being, and therefore there is very little chance of the BTC being in risk on, and therefore the downside in BTC is more open than the upside. Do this chart for yourself. You won't regret it. You will see immediately what the trend is. Here it's just been unable to rally for 2 weeks, and what has BTC shown? That it can't rally either. It is so obvious that 60/40 is the high here. We just cannot break through it on a monthly basis, as it were. Every time we get to 60/40, we have sellers on the monthly charts, on the weekly charts, on the daily charts. It's all the same. We just cannot break through 60/40. So on the short term, we are very, very coiled here, and I really wouldn't be surprised to see moves down to 59, 58, 65 over the course of the next few days on this Middle East tension. But again, unless we start breaking 58, 65, this is not weakness. It's just sideways trading, gap filling, etc. So I really wouldn't get too excited until we break 58.65, and that is only likely to happen if this Middle East situation escalates. Are we going to open lower? Yes, we are, but we are probably going to rally back towards the close at some stage tomorrow. If we can't start going above, and this is to me as clear as daylight, if we can't close above 60/40 at any stage before the end of the month, we are at best going sideways and at worst filling gaps all the way down to 57.65. But only weakness below 58.65 shows any immediate danger of downside. NQ is definitely stronger than the S&P. It will be very interesting to see if we can close the month on a new high, 21,478 on the NDX. we are definitely going to be around it, and it'll be interesting to see if we can break it. 22,100 is the level that we just cannot break. Every time we get up there on the weeklies, we get knocked back. And really, I would not be surprised to see at some stage these gaps get filled over the course of the next couple of weeks. But unless it starts trading below 20,660, it's just not weak. That level is somehow comparable to the previous level that I gave you in ES here at 58.65. And it's just very clear that if we go to the clean chart and we actually enlarge it, it's very, very clear that really this level here is going to be very big support. Breaking it opens the downside all the way to 57.62 and probably weakness in NQ as well. All the foreign markets show more or less the same thing, that we have peaked up here in Europe around the 54.50 area, and that we could easily trade down to 50.80, 5100 to support. And even over the monthlies, it's showing that it's coming into an exhaustion, and we probably will trade here for another couple of months. Given that, I see very little chance that we are in an impulsive up stage for equities. And if we look at Japan, same thing, we just cannot break, sort of get the 200-day to go positive. On the monthlies, we are failing. We just cannot get anywhere near the previous highs, which tells me that we are in a consolidation phase still before we start the next leg, whenever that might be. But it's not going to be for a while, I don't think. And EEM, it's absolutely going to trade 45.04 at some stage. And I think that that is probably the first level you buy, and then you wait for something like 43 to double up and look to make some money into the end of the year. I think EEM is definitely a better bet, or some foreign markets are a better bet than the US still. But I think that in everything we are in a sideways to down period, whether the weakness spreads or not, and it becomes more extreme that we're going to see on the open of Monday, because that's just a gut reaction, depends very much on the course of events over the next few weeks. I don't think that this conflict will spread. I hope the Iranians are not as stupid as to do something really silly like close the Straits of Hormuz, because the US is just going to batter them. And that would be a great buying opportunity when equities absolutely sort of crater on the back of that, and a selling opportunity for oil, because it's not going to last. The US is going to go absolutely berserk when that happens and just sink every ship in their navy. So to me, it's much more likely to be a contained downside in equities than a complete collapse. Now, vol on Monday is bound to be bid, but if we really can't get anywhere above 27.28, that's going to be a signal that the market thinks that this is contained to an event that lasts a few days. And if we close below 27 or so on Monday, I think that we are likely to fill the gap over the course of the remaining days of the week, and then we see. This could be, just a one-day wonder, and volatility is going to tell us, because, as I said, closes 27 or lower, the market is saying that this is no big deal. In synthesis, what I'm saying is that I don't think there's anything to do in the steepeners, and you can't have a flattener. So the steepeners you can only do from levels, and you need to be patient, and you need to avoid doing them as twos anything. You probably need to do them as fives something, fives tens, tens 30s. So something with duration against something with more duration, but at levels. It's going to be a slow period in terms of bond yield curve, but it should be an interesting period in terms of equities. I am definitely not a buyer of equities here, but I'm not a big seller either. I think that there will be very vicious bounces all the way up to wherever we closed on Friday over the course of the week if nothing more happens in Iran. If this is it, we are going to get big bounces, but unless it starts closing above 60.40 towards the end of the week, this is still a range trading market, which at some stage will trade 58.65 and bounce from there the first time, second time, but only below 58.65 you have weakness in equities in general. And the fact that all the other markets, related markets like EM, Nikkei and stocks are showing signs of exhaustion for this move tells me that we're going nowhere in equities but trading support levels, more likely to trade support levels than resistance levels, and that's about it. BTC showing the same. It just cannot close above this level, and while that is ongoing, you are more likely to trade down towards 91,635 than have strength, and that reflects the whole of the risk complex. Thank you very much indeed, and I will tweet you tomorrow.